Howdy, Jacob here. Today we're looking at CEVA in the semiconductor and semiconductor equipment industry. 485 million market cap on 327 million enterprise value. Looks like they have very little net debt. On a sub-billion dollar company, I do like to look at insider ownership, and we do see about 2% of shares are held by insiders. Pretty low. I do like to see roughly 10% or higher. I mean, again, everything creates a story. It doesn't mean you need to invest in it versus not just by that metric. It just, again, is one of the many metrics that I like to look at. Looks like they provide silicone and software IP solutions to semiconductor and original equipment manufacturer. Its 5G mobile and infrastructure products include XYZ. Okay. Incorporated in 1999 out of Maryland. So for how small they are, they actually they've grown quite a bit over the last 10 years, but recently are not growing as much, and in fact declined 19% in revenue the last couple of, over the last year. Gross margins are very impressive, declining a little bit, but still 88%. So I don't think anyone's angry about that. Operating margin is having trouble getting back to what it was in 2016, 2017, almost 20%. And so we'll have to see whether it's because they're just investing quite a bit in R&D, but it doesn't look like they have a lot of debt, which we can see through their return on equity and their return on invested capital being identical. Their income statement shows quite a bit of quite a bit of money invested in research and development. Again, this is going to take away money from today to hopefully get more in the future. And their R&D is absolutely humongous. 73 million over 97 million. I mean, you're looking at that's over 70% of their revenue is being expensed through R&D. So they are reinvesting a hefty amount back into themselves to try to grow faster. And it looks like again it did work pretty immensely from 2014 to 2022, but they did have a hindrance in 2023. I know the semiconductor industry can be quite volatile, so maybe that's what's happening. But as we see here, 166 million in cash-like products, 40 million in total liabilities, no short-term, no long-term, just 4 million in capital leases. So again, it's really tough to go out of business if you're making money and you don't have debt. I mean, I'm sure it can be possible. I can't really think of a way how, but if you have a bunch of cash on hand and you make money and you have essentially no interest-bearing debt, it's terribly difficult to go to business. So this would be a very safe investment. But again, everything is most investments are the present value of free cash flow. So we'll have to see whether it makes sense from that perspective and not just be a safe, quote unquote, safe company to invest in. So free cash flow is actually going negative over the last 2 years and has been going down since 2021. CapEx is still very small. They are issuing quite a bit of shares through stock-based compensation, buying back a little bit with their free cash flow, and mostly just reinvesting back in themselves, a little bit on the acquisition side. So use of cash is pretty reasonable. A lot of reinvestments, a couple acquisitions, a couple share repurchases. So let's start making some assumptions here. On the revenue growth side, I think through all their reinvestments, with so much capital allocation going towards acquisitions and reinvestment, I have a tough time thinking that they can't get back to, maybe even 8% revenue growth. They're reinvesting so much, we don't necessarily know, or we can't see whether there's a huge return on invested capital or not. And so for me, I might just go a little, pretty much market average, maybe on the slightly higher side. As for margins, I mean, I think you could get way higher margins in this industry. The thing is, if they were to cut their R&D in half, they would be making 40 million or so in operating profit, which would be 30% margins here, 25% margins here. So again, they're likely not going to be doing that, but I do think that that will help future growth. And so maybe in 7 years, they're able to get a 10 and 15% margin, which I might even still be too small there. Let's do 15, 20. Again, it's creating a story because they haven't really had these type of margins in the past. but they are spending so much on research and development. For share change, I mean, they are issuing a bit of shares through stock-based compensation, 16 million. Maybe they buy back a little. That'll be about 2 million. This is saying they reinvest a whole lot, maybe make some acquisitions to get 8% and these type of margins. It just looks a bit expensive, even with the story I'm trying to create. So for me right now, I really don't like creating stories when I'm not entirely confident, unless I have a huge margin of safety. Obviously, I enjoy investing in companies that I think are going to grow very heavily, but for me right now, I don't think it's going to grow as much as the current valuation says it will be. So either way, I hope you enjoy the video and have a great rest of your day. Thank you.